If you make less than $60,000 a year, the system is not designed to keep you struggling. It is designed to keep you exactly one car repair away from struggling. Let that sink in for a second. Most people think being broke on a low salary comes down to a bad job or bad luck. It does not. It comes down to a number nobody tells you to watch, not your paycheck, your interest rate. Here is the ladder. A person with excellent credit buying a used car today pays around 6% interest. A person with average credit pays around 11%. But a person earning under $40,000 a year, the exact person who needs a reliable car the most to get to work, often gets offered 18, 22, even 26%. Same car, same four wheels, nearly quadruple the cost of borrowing. That is not a coincidence. That is a business model. Here is the sentence I want you to remember because it is the whole video in one line. The less money you have, the more it costs you to borrow money you do not have. Say that back to yourself. It sounds backwards. It is backwards, and it is completely legal. This is not a video telling you to stop buying coffee. This is not a video shaming you for being poor. This is a video about a $19,000 car that will actually cost one man $41,000, and why almost nobody making his salary ever finds out until it is too late. Because the truth is, low income does not just mean less money coming in. It means a higher price tag on every single dollar you have to borrow to survive. Rent deposits, car loans, credit cards, emergency cash advances. Every door costs more to walk through. So let's expose exactly how this machine is built, one number at a time. Here's the mechanism nobody puts in the brochure. Auto lenders do not price loans based on the car. They price loans based on a formula called risk-based pricing, and the input that matters most is not your income, it's your credit score, which is really just a proxy for how desperate your options are. Here's the math. Say you finance a $19,000 used car over 6 years, which is now the average loan term because monthly payments have gotten so unaffordable that lenders had to stretch them out just to keep people qualifying. At 6% interest, that car costs you about $22,400 total. Annoying, but survivable. At 22%, the rate a lot of subprime borrowers actually get offered, that same $19,000 car costs you $32,900. You paid nearly double the car's value just for the privilege of not having $19,000 sitting in a bank account. And here's the twist that makes it worse. Cars depreciate fast, losing roughly 20% of their value in the first year alone, which means for a huge chunk of that 6-year loan, you are underwater, owing more than the car is even worth. If your transmission dies in year 3, you cannot sell the car to escape the loan. You'd have to pay extra just to walk away from it. Zoom out, and this is not a rare, unlucky story. Roughly 1 in 5 auto loan borrowers in America is underwater on their vehicle right now, owing more than the car could sell for. This is not the exception. This is the median experience for lower-income borrowers. Here's the part that should make you angry. The lender is not betting that you will pay the loan off comfortably. The lender is pricing the loan assuming a percentage of people like you will struggle, miss payments, or default, and building that expected loss into everyone's rate in advance. The bank already priced in your bad month before you've even had it. Meet Daniel, 34 years old, works as a warehouse shift supervisor, brings home about $3,300 a month after taxes. Solid guy, shows up early, coaches his nephew's Little League team on weekends. 2 years ago, his old sedan died on the highway, and he needed a car fast because missing a week of shifts meant missing rent. He financed a $19,000 SUV. Nobody at the dealership lied to him. They just handed him paperwork with a 23% interest rate buried in it, smiled, and told him his payment would be $489 a month. That number fit his budget. What didn't get explained was that $489 a month for 72 months adds up to just over $35,000 for a car that was worth $19,000. Run Daniel's numbers. Rent is $1,100, utilities and phone $200, groceries $500, insurance on that same SUV because higher risk drivers also get charged more for insurance, $160. Add the car payment and Daniel has about $250 a month left over for everything else life throws at air. 1 dentist bill, 1 brake job, 1 week of reduced hours. That $250 disappears, and Daniel is now choosing between the car payment and groceries. Now the objection. You might be thinking, but I need a reliable car to get to work. This isn't optional. And you're right, it usually isn't. But here's the data that matters. Studies on car buying behavior show a majority of lower-income buyers never shop their loan around to a credit union or a second lender before signing at the dealership. They take the first number offered because they're exhausted or embarrassed or told it's the only offer they'll get. It rarely is. The problem for most people isn't that they needed a car. It's that they needed a car and had exactly one number in front of them. Daniel isn't lazy. Daniel isn't bad with money. Daniel just never got taught that the interest rate was the actual product being sold to him, not the car. Here's the boring alternative nobody wants to hear because it doesn't feel like a solution in the moment. Before signing anything, get pre-approved by a credit union first, separately from the dealership, even if it takes an extra 2 days. Credit unions often offer rates 6 to 10 points lower than dealership financing for the exact same borrower, because they're not pricing in a dealer markup on top of the loan. Let's run Daniel's numbers with that one change. Same $19,000 SUV, same 6-year term, but at 12% instead of 23%. His payment drops from $489 to about $377. That's a difference of $112 a month. Doesn't sound life-changing, does it? Now watch what happens if Daniel takes that $112 difference and puts it into a simple index fund every month instead of letting the dealership keep it for 30 years at an average historical return of 7%. That's not $35,000. That's over $135,000. One decision made in a 15-minute phone call before walking into a dealership is worth more than 4 times Daniel's salary by the time he retires. So who actually wins when Daniel signs at 23% instead of 12%? The dealership's finance manager, who gets a commission on the interest rate itself, not just the car. The lender, who collects $16,000 extra in interest for the same risk they'd have taken at a lower rate. The insurance company, charging more because the loan flags them as higher risk. Everyone in that chain profits from Daniel not making one phone call. Nobody in that chain is rooting for Daniel. Here's your actual next step, today, not someday. If you have any loan, car, personal, even a credit card, call one credit union this week and ask what rate they'd actually offer you. Just ask. It costs nothing and takes 15 minutes. Now the honest exception. If you've already shopped your rate, if a credit union genuinely couldn't beat your offer, if your situation is different, this isn't about you, and you're excused. This video is for the person who never got asked the question in the first place. Because the truth is, being poor was never really about the paycheck. It's about being the person everyone assumes won't check. The bravest financial decision most people will ever make isn't earning more. It's the 15 minutes they spend refusing to be the person nobody expected to ask.